Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over where money is created, the majority of it. We're going to talk about fractional reserve lending. And then I'm going to go and paint a picture of our current real estate market because that's where the majority of the money comes from, is residential bank loans. So I'm going to step through all this, which gives support to the thesis of the channel so you guys can better understand our entire system. This is important to investing because this is really where inflation comes from. The bulk of it, not all of it, but the bulk of it. So let me go in here. This is a culmination of a whole bunch of different articles and some data. And I'll try to step through everything to show you kind of what I already know because I already did the research, but I guess I don't think I've laid it out for the channel in this manner. So let's dive in and I'll give you my opinion here. It says some background information. It says fractional reserve banking is a system in which only a fraction of bank deposits are backed by actual cash on hand and available for withdrawal. This is done to theoretically expand the economy by freeing capital for lending. It should be clear that modern fractional reserve banking, and this is an opinion, is a shell game, a Ponzi scheme, a fraud in which fake warehouse receipts are issued and circulate as equivalent to the cash supposedly represented by the receipts, being guilty of fraud. And that's the morality of fractional reserve banking, just to throw that in there. Looking on the right-hand side, most of the money in our economy is created by banks in the form of bank deposits. The numbers that appear in your account, banks create new money whenever they make loans. 97% of the money in the economy today exists as bank deposits. Willis, just 3% is physical cash. Again, guys, 97% of the money in the economy today exists as bank deposits. What that means is that the money is being loaned into existence, and that money being loaned into existence is 97% of the money supply. Just wanted to get that across. Coming here. This is from an article in 2016, but I propose that the biggest banking change during the last 60 years is none of these. It is instead the dramatic shift to real estate finance and thus real estate risk. As the dominant factor in the balance sheet of the entire banking system, it is the evolution of the banking system from being principally business banks to being principally real estate banks. In 1955, commercial and industrial loans were 40% of the total banking loans, and real estate loans only 25%. The great banking transition set in after 1984. The share of C&I loans kept falling, down to about 20% of total loans, while real estate loans rose to about 50%, with a bubble-induced peak of 60% in 2009. In this remarkable long-term shift, the share of real estate loans doubled, while the share of commercial and industrial loans dropped in half. The lines crossed in 1987, 3 decades ago, and never met again, despite the real estate lending busts of the early 1990s and of 2007 to 2009. So on the right-hand side, it says a portfolio makeover. The commercial and industrial lending that made up 40% of total loans in 1955 has been eclipsed by real estate lending over the past 60 years. The commercial and industrial loans are the orange line. The real estate loans is the blue line. The blue line has increased dramatically in relationship to commercial and industrial loans. So real estate loans are starting to make up the majority of bank lending. So one can conclude that the majority of our money supply is based off of real estate loans because the majority of commercial bank loans are real estate loans. And if 97% of the money supply comes from commercial bank lending, then the majority of the money supply goes against real estate loans. So to make it simple, it says when that loan is made, it increases the money supply. This is how banks create money and increase the money supply. When a bank makes loans out of excess reserves, the money supply increases. The money supply is positively related to the real estate price. That is, The increase of the money supply will lead to the rise of the real estate price. So we have a positive feedback. I'm gonna kind of sum this up here. Fractional reserve lending creates or expands the money supply. It's a leveraging up. That leveraging up creates a money supply and puts money into the system known as bank deposits. It's expanding the money supply. The majority of bank lending comes from residential real estate. It's 50 to 60% of all of bank lending. And it could go up or down depending on the amount of loans that are created against residential real estate. The higher the loan growth, and if you're going into an expansionary phase of real estate, you're going to have more and more loan growth in residential real estate as it grows faster and faster. So I would suspect that the percentage of loans in an expansionary phase of real estate will go up. The share of residential real estate loans will go up of bank lending. Now, what I want to do is I want to look at what is the situation in residential real estate. Because if the majority of loans come from residential real estate, and that is the majority of money creation in the M2 money supply from commercial bank lending, we need to see how out of balance the residential real estate market is. This will determine how much inflation we're going to have in the system. So this is the fuel for a higher inflationary environment with higher potential, higher interest rates. And if they can't raise rates, I'm going to say the potential for lower dollar value. The value of the dollar should decline quite dramatically if they are successful at holding rates down while we have inflation being persistent. So next, we're going to look at housing starts, the formation of families, the ratio of how many homes we have per population. This is where I get kind of, this is where knowing this information, and not many people know this information that I'm about to present here, that are finance type related. This is what gives you the edge as an investor, I think, is this type of information. So here we go. What I'm going to do is I'm going to skip that one right there. It says the housing supply and prices. This is the percent change. This here is the housing supply. Think of it as inventory. Here's your inventory declining, declining, declining. We are at really low inventory levels in 2021. And obviously on the housing price is going up as our inventory is declining, especially to critical levels. So our percent change is going up. We have very low inventory. What it needs to do is kick on the housing supply, the housing starts. So going on up, this is your housing production. So this is your housing production has not kept pace with population growth. This is the percent of housing starts as a share of population. And here's your time. Your housing starts have declined over time quite dramatically against the population out there. So our housing starts are declining in relationship to the population. I put a little downtrend line on this. And then we're about to break to the upside of our housing production, which means we need to kick on far more homes and produce far more new homes to get the housing to population growth more in balance. So the housing production has not kept pace with population growth. And what that means is early this year, and this is from different articles, guys. I've gotten this from a whole bunch of different articles. It says earlier this year, Realtor.com estimated that the gap between the number of homes needed and the number of homes available at 5.24 million. That estimate is in June represents an increase of 1.4 million above the estimated 3.84 million gap in 2019, primarily because residential construction hasn't kept up with household formations. And that's what exactly this chart is signaling and showing. It hasn't kept pace with the population growth. It's continuing to decline. From January 2012 to June 2021, 12.3 million new American households were formed, but just 7 million new single-family houses were built, according to Realtor.com. This is the population-adjusted single-family housing starts, similar to what we saw up there. The average starts per 1 million people. They were quite dramatic in the 60s and 70s, but they've been declining over time. And in the 2010s, we've had a serious problem. We are massively underbuilt for the housing starts in relationship to how many people there are. Looking at the ratio of housing units to new households formed, you can see the historical average is around a little bit under 1, and the housing completions per new households have dropped dramatically in the 2010s. So we've had a dramatic underproduction of homes. And looking at some of these other articles, it says the US housing market is down at least 5.5 million units. Now, here's something that isn't accounted for, that people are accounting for either. It says accounting for losses of existing homes and underproduction brings the total to 6.8 million homes, not 5.5, because you're going to be losing homes as old homes have to be destroyed. So builders can still solve the problem, but the report suggests it will take a Herculean effort over the next decade. Residential construction would need to accelerate to an annual pace of more than 2 million units per year. That rate would represent a 60% jump from the annual pace of roughly 1.3 million units in 2020. Data out Wednesday morning signals contractors are far from reaching such a goal. Housing starts rose 3.6% in May to an annualized rate of 1.57 billion units. While the data does show improvement from April, it still sits below highs seen earlier in the year and missed the median estimate of 3.9. So when you look at this, the housing starts volume, what they are suggesting is that it's going to take a massive effort to catch this market back up to an equilibrium. They're saying that we need to build more than 2 million units per year for 10 years. That is larger than any housing boom in history of America. It's far larger than the 1970s. This imbalance is what's going to drive loan growth. Because if we can successfully build these homes, it's going to drive loan growth. Loan growth and the credit expansion phase is going to be very inflationary because that's where the money is being created. That's where our M2 money supply is growing. It's the bank deposits from the loans. And if the majority of the loans are against residential real estate, and if we go into a massive expansionary phase of real estate to catch the market back up, that loan growth will be even greater against residential real estate. And as prices increase and as inflation comes into the system, it feeds on itself. It's a positive feedback loop where more inflation feeds more inflation, which feeds more inflation. And that more inflation is going to drive home prices even higher. And that inflation of the inputs is going to drive new home starts higher. The cost of new homes, I should say. So the volume of new home starts is going to be inflationary, and that inflation is going to feed back on itself. That's the predicament we're in. That if we were continue to build these homes, and we're at 1.7 million homes were built last month for new housing starts, and what's going ahead for permits is like 1.9 million almost. So we're coming up to that 2 million mark. This is going to be inflationary, guys. Get ready. Your portfolios are going to do very well if you're part of the channel. You're part of the commodity boom. That's kind of how I'm playing it, is commodities and precious metals. And this is our driver. So we just looked at what's driving this and where the shortages exist and where the loan growths are coming and where the money supply grows. This is your driving or leading indicator. This is the root cause of where the money's coming from, in my opinion. If you guys like this analysis, give me a thumbs up, subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.